Hi guys, last class we have studied about the monetary policy and we have actually covered the basic concepts of monetary policy, right? Last class we have studied about the basic concepts of monetary policy and today we are actually going to cover the rest of the topic or the more aspects of the monetary policy. So last class we have stopped while giving a last basic concept of monetary policy. So monetary policies are basically having two types of monetary policies. One is expansionary monetary policy, and other is contractionary monetary policy. So these two monetary policies, there are basically two types of monetary policy. One is expansionary monetary policy and other is contractionary monetary policy. So expansionary monetary policy is applied by the Reserve Bank of India during inflation or deflation. It is mostly expansionary monetary policy is done to expand the economy or to give out money into the economy. So which is the condition of the economy where there is no quantity of money in the economy, or there is no quantity of money in circulation in the economy, that is deflation, right? So expansionary monetary policy is applied during the deflation, when there is deflation in the economy, and the contractionary monetary policy is applied on the economy by the RBI during inflation. So its logic is pretty simple. So what do you mean by deflation? Deflation is nothing but what the quantity of money supply in the economy diminishes or reduces. As a result, we need money in the economy. So to pump in money into the economy, RBI is actually implementing expansionary monetary policy. On the other hand, during during inflation, there is surplus money in the economy and there is more than enough money in the economy. As a result, the value of money diminishes. As a result, what RBI does is introduce contractionary monetary policy is to reduce the money in circulation. So that is what we call as inflation. So during deflation, RBI decreases all rates fixed by RBI. So during deflation, all the rates fixed by RBI are decreased, and during inflations, all the rates fixed by RBI are increased. So you may have doubt, we can discuss that. Are increased. So what do you mean by rates? So here rates means it can be cash reserve ratio, or it can be bank rate, it can be repo rate, or it can be reverse repo rate. So these are the rates which are mentioned here. So during inflation, what happens is, or during deflation, what happens is, during deflation, RBI actually decreases all rates fixed by the decreases all the rates like CRR, bank rate, repo rate, and reverse repo rate. So look, why RBI decreases these rates is because once these rates are, so I'm talking in the case of deflation, okay? In the time of deflation, when the rate is decreased by RBI, what happens is the loans taken by the commercial banks, loans taken by commercial bank increases because the rate is very cheap. As a result, the loans taken by commercial bank from the RBI also increases. As a result, the lending capacity of the commercial bank increases, right? As a result, the overall the quantity of money supply in the economy increases during deflation. So I hope you guys understand. During the RBI has two monetary policies. One is expansionary monetary policy, another is contractionary monetary policy. So during deflation, RBI implements expansionary monetary policies, as during deflation there is no money in the economy. So in order to pump money in the economy, what RBI does is RBI decrease all the rates fixed by the by the central bank or by RBI. All the rates are reduced by the RBI. As a result, when rates are proportionally reduced, what contrarily happens is the loans taken by the commercial bank goes up. So now the loans are very cheaper. As a result, what happens is the loans taken by the commercial bank goes up. As a result, the lending capacity of the uh, commercial bank goes up. As a result, the quantity of money in the circulation in the economy also increases. So this is the same thing happens during inflation as well. So during inflation, what happens is during inflation, the RBI increases all the rates. So during inflation, RBI increases all the rates. So when all the rates are increases, the loans by commercial banks decreases. The loans taken by commercial bank decreases now, as the loans are highly what expensive. So taking loan is very expensive, as the rate fixed by RBI is high. So as a result, the commercial banks stop taking loans. As a result, the lending capacity of the commercial bank, the lending capacity diminishes. Lending capacity diminishes, and the quantity of money also decreases. So this is actually what happens during inflation and what is happening during deflation. So we can discuss this again. I'm actually going to explain this topic once more. So RBI has two monetary policy. One is expansionary and other is contractionary monetary policy. What is deflation? So expansionary monetary policy is applied during deflation. So deflation is the economic quantity where the quantity of money in circulation is less. Money is less, and inflation is a situation where quantity of money in circulation in the economy is high. So these are two aspects of economy. One is deflation and inflation. During deflation, RBI, as during deflation there is no money in the economy, so in order to pump in money in the economy, what RBI does is RBI introduce or implement expansionary monetary policies. During expansionary monetary policy, what RBI does is RBI decreases all the rates. Rates are examples of rates are cash reserve ratio, statutory liquidity ratio, bank rate, repo rate, reverse repo rate, and all the rates are being decreased by the RBI. As rates are decreased by RBI, now for commercial banks to take loan, it is very cheaper. So the commercial bank take more loans, as there is the rate fixed by the RBI is very less. As a result, they get cheaper loans. And what happens is RBI lend these loans to the public. So the lending capacity of the commercial bank also goes up. As a result, the quantity of money in the circulation during deflation goes up. As a result, the deflation can be controlled by expansionary monetary policy. On the contrary, during contractionary monetary policy, the RBI contraction monetary policy is applied or implemented during inflation, as there is humongous amount of quantity of money in circulation, and as a result, the money values, the currency value diminishes. So in order to control inflation, what commercial bank does or what RBI does is RBI increases the rates. So when the rates are increases, so it is very expensive for the commercial banks to take loans. As a result, the lending capacity of the commercial bank goes down. As a result, the quantity of money in circulation goes down, and this is how the inflation is curtailed by the Reserve Bank of India by what progressive monetary policy. So there are two kinds of monetary policy we have discussed. One is expansionary monetary policy and other is contractionary monetary policy. So I hope you guys understood this. Now we are going to discuss about the tools of now we are going to discuss about some of the tools used by RBI, tools used in monetary policy by RBI to control the expansion and contraction of monetary policy. So tools used in monetary policy for controlling economic fluctuations. So what may be the tools which are used by RBI? So there are basically two tools used by RBI. One is actually quantitative tools and other is qualitative tools. So quantitative tools are tools which are numerical in nature, whereas qualitative tools are qualitative in nature. So we can discuss about this detailed one at a time. So these both are credit control measures taken by RBI to control inflation and deflation. These both are credit control measures taken by RBI or Reserve Bank of India to control both inflation and deflation. So first we can learn about quantitative tools and after that we can learn about qualitative tools. So first we can learn about quantitative economic tools. So quantitative economic tools So first quantitative economic tool is bank rate, or discount rate. And second economic quantitative tool is reserve ratio requirement. There is two reserve ratio requirements. One is CRR, cash reserve ratio, and other is SLR, statutory liquidity ratio. Third is liquidity adjustment facility. LAF. There are two kinds of LAF. One is repo rate and other is reverse repo rate. Fourth is marginal standing facility rate. That is MSFR. And fifth is standing deposit facility rate. And sixth is open market operations. And seventh is market stabilization scheme. Okay, we can look. So the quantitative economic tools are those tools which are taken by RBI to control the credit control the inflation and deflation in the economy. There are mainly seven types of quantitative economic tool. One is bank rate or discount rate, another is reserve ratio. The reserve ratios are classified into one is CRR, another is SLR, and third is actually liquidity adjustment facility or LAF, and this is actually again classified into one is repo rate, another is reverse repo rate, and fourth is marginal standing facility rate, that is MSFR facility, and fifth is standing deposit facility rate. This was actually introduced in the year 2022. These are latest quantitative economic tools introduced by RBI, and sixth is open market operations, and seventh is market stabilization scheme. We can actually look all these at detail. So first we can learn about what is bank rate. So first we are going to learn about first quantitative tool. One is bank rate. So we are going to learn about what is our bank rate. So this is RBI and this is commercial bank. So we are going to learn what is bank rate, and this is RBI and this is commercial bank. So bank rate is a rate at which RBI gives long-term loans. RBI gives long-term loans to commercial bank, and as a result commercial bank pays back interest to the RBI, and this is what is known as bank rate. So what RBI gives long-term loans to commercial bank, and in addition to the long-term loans given by RBI, commercial bank gives back loans at a particular rate or interest, and that interest is known as interest rate at which commercial bank gives back the uh, what the borrowed money from RBI is known as bank rate. So RBI gives long-term loans to commercial bank, and in against the long-term loans, commercial bank gives interest back to the RBI, and the interest charged by RBI against the long-term loans given by Reserve Bank to the commercial bank is known as bank rate. So the current bank rate as on October was 5.75%. So what does this mean? If RBI gives 100 rupees, if RBI lends 100 rupees to commercial bank needs to pay 105.75 rupees back to the RBI. So if RBI pays 100 rupees to commercial bank, the commercial bank need to pay back to RBI of 105.75%, 5 rupees. So this is what bank rate is all about. So bank rate is the long-term loans given by the Reserve Bank of India to commercial bank against an interest charge, and that interest charge is known as bank rate, and currently the bank rate is 5.75% as on October. Every 2 months the bank rate, the repo rate, all these rates, RBI keeps on changing these rates according to economic fluctuations. So the currently as on October the current bank rate is 5.75 fixed by the RBI. So this is an actually example. I'm just give you an example. If 100 rupees is given by RBI to commercial bank, then the commercial bank needs to pay out 105.75 rupees back to RBI. So this is what bank rate is all about. So I'm just explaining that portion again. During inflation, what happens is, during inflation, the RBI increases the bank rate. During inflation, the RBI increases the bank rate as there is a lot of money in uneven money in circulation in the economy. So in order to slow down the money in circulation, what RBI does is RBI increases the bank rate. As a result, the loans taken by commercial bank from RBI, loans taken by commercial bank from RBI decreases. As the loans taken by commercial bank decreases, the lending capacity of the bank also decreases. As a result, the quantity of money supply also decreases. So this is what happens during inflation. During inflation, what happens is there is enough lot of money in circulation. As a result, the bank rate, RBI increases the bank rate. As a result, when bank rate is increased, so it is now very expensive for the commercial banks to get loan from RBI. So as a result, the loans taken by commercial bank from RBI also decreases. As a result, the lending capacity of RBI, of the commercial bank also decreases, as there is no customers taking loan from commercial bank is very expensive. So the customers won't take what loans from commercial bank. As a result, the lending capacity of the commercial bank decreases and the quantity of money in circulation also decreases. Thus, inflation can be curtailed or can be controlled in this manner. Similarly, during deflation, so what is deflation? So during deflation, there is what less amount of money in circulation, and the quantity of money in circulation in the economy is very less, as there is no money in the hands of people. As a result, we need it is a duty of the RBI to get money in the hands of people, so that, or to to curtail the deflation in the economy. So as there is no money in the hands of people, what happens is RBI decreases the bank rate. So RBI decreases the bank rate. So as when bank rates decreases, what happens? The loans taken by commercial banks increases, as now the loans are cheaper. As a result, the lending capacity of the commercial banks also increases. As a result, the quantity of money supply increases. So this is how the deflation can be also controlled. So this is actually a very cyclic process, and this is what happens during bank rates. And this is true for all the rates, whether it's repo rate, reverse repo rate, or any other facility. This during inflation and deflation, RBI controls the rates fixed so that they can control the credit control measures. Now we are going to learn about the reserve ratios. Second is what we are going to reserve requirements. So what is reserve requirements? So reserve requirements is reserve requirement is a requirement facility that out of the total deposits, out of the total deposits, so commercial bank, the commercial bank need to keep a certain percentage of their deposits as reserves, and rest of the amount is only allowed to be rest of the amount is to be is only allowed to be given loans to the public. So that means every commercial bank needs to keep a certain percentage of their deposits as reserves, and among within that reserves the bank cannot give loans, and the rest of the amount only the commercial banks are allowed to give loans to the public. So this is what reserve requirement is all about. So before going to the explaining more about reserve requirements, we need to know what are deposits. I told you that out of the total deposits of commercial bank, a certain percentage of their deposits should be kept as reserve, and rest of the amount, after keeping a certain amount as reserve, the rest of the amount is only be allowed to give loans to the public. So what is that? I told total deposits. There are basically two types of deposits. One is demand deposits, and other is time deposits. So these are deposits which should be withdrawn on the demand of the customers, and these are deposits that can be withdrawn during maturity. So in total, the deposits held by commercial bank are known as NDTL, or net demand time liability. I hope you got this much. Okay, so the deposits in India are basically classified into one is demand deposits and other is time deposits. And demand deposits are those deposits which can be withdrawn by the customers on the demand of their customers, or demand of the on the want or on the will of the customers, that deposits can be withdrawn. And time deposits are those deposits that can only be withdrawn at the time of maturity, or at a fixed period of time, or fixed interval of time. So these are the basic deposits. So the total deposits held by the commercial bank is known as NDTL, or net demand time liability. I hope you guys understood this much. Now we can go and study in detail about reserve requirements. So reserve requirements are classified into two. One is CRR and other is SLR. So CRR, I hope everybody knows what is CRR is. Actually full form is cash reserve ratio. whereas SLR is statutory liquidity ratio. So CRR is a percentage of the net demand time liability, a percentage of NDTL that commercial bank should maintain a reserve in cash to the RBI. So what is the cash reserve ratio? So among the total net demand time liability or the total deposits held by the commercial bank, the commercial banks cannot lend the entire amount to the public. So certain percentage should be maintained in cash as reserve to the RBI. So this certain percentage of the total deposits or the net demand time liability should be maintained in RBI as in the form of cash, and they can't lend on that money. Similarly, a certain percentage of NDTL should be maintained by commercial bank in gold, cash or securities in commercial bank itself. So I hope you guys understood this. That is, among the total deposits, the commercial bank need to maintain that amount. Among the total net demand time liability, the commercial bank need to maintain a certain percentage in cash, and among the total net demand time liability, the commercial bank should maintain a certain percentage in gold, cash or security. So this is what cash reserve ratio is all about, and statutory liquidity ratio is all about. I can explain this again. So the CRR rate as on October was 3.75 percentage, and the SLR rate as on October was 18 percentage. So I am explaining this. If consider the total deposits or net demand time liability is net demand time liability of a commercial bank is rupees 100. So among this 100, the commercial bank cannot lend the entire money to the public. So among this 100 rupees, the commercial bank need to maintain CRR of 3.75 percentage to RBI, and in the form of CRR is maintained in the form of cash, and SLR of 18 percentage in bank or commercial bank itself. They need to maintain their SLR in the form of cash, gold or securities. So now the total is 21.75. So approximately for 22 percentage, bank alone cannot lend this 22 percentage of net demand time liability to public. So commercial bank can give loan to the public only the 70 only to 78% bank can lend or give loan to the public. So this is the concept of reserve requirement. So this RBI, according RBI fixes a reserve requirement, that is in both CRR, cash reserve ratio, and uh, SLR. That is, if there is 100 rupees, the RBI needs the commercial bank needs to keep 3.75% in cash with the RBI, and 18% or 18 rupees should be kept as reserve in commercial bank itself, and total the 21.75% or approximately 25% of the money of net demand time liability cannot be used for lending purpose, and it should be kept as reserve by the commercial banks, and rest of the 78% only the commercial banks are allowed to lend to the public. So this is the concept of reserve requirements. So last concept, today we are going to wind up the sessions by learning one more concept. One is liquidity adjustment facility, LAF, or liquidity adjustment facility. So in order to adjust the liquidity or the easy convertibility of cash of both RBI and commercial banks, LA facility is introduced. So there are two types of LA facilities. One is repo rate, other is reverse repo rate. So there are two types of liquidity facilities. One is repo rate and other is reverse repo rate. So we can learn this both in detail. So current repo rate is, as on October, is 5.50%, and current reverse repo rate is 3.35%. So we can learn this in detail now. So what is repo rate? So first we can learn repo rate, then after that we can learn reverse repo rate. So what is repo rate? So this is RBI and this is commercial banks. So RBI gives short-term loans to commercial bank, and in against the short-term loans given by RBI charge an interest, and this interest is known as repo rate. So the difference between bank rate and repo rate is that the bank rate is a long-term loan given by RBI to the commercial bank, whereas repo rate is a short-term loan given by RBI to the commercial bank. So we need to understand the concept perfectly. So bank rate is a rate at which RBI gives long-term loans to commercial bank, whereas repo rate is a rate at which RBI gives short-term loan to bank rate to commercial bank. In against the loan given by RBI charge an interest rate that is known as repo rate, and currently the repo rate is 5.5%. We have discussed that earlier. So this repo rate is also known as repurchase rate. So now I hope you guys understood what is repo rate. Now we are going to learn what is reverse repo rate. So reverse repo rate. So that word itself suggests the meaning of reverse repo rate. So this is also very simple concept because this is a reverse process of repo rate. So this is RBI, this is banks. So the reverse process happens, that is commercial bank gives short term loan to RBI, and RBI gives interest back to the commercial bank, and this is known as reverse repo rate. So as the process of repo rate is reversed here, this process is known as, or this rate is known as reverse repo rate. And reverse repo rate is the least rate among all rates. Is the least rate, means this is the rate which is having the least value, or the leastly charged rate among all the rates is reverse repo rate. That's a very important point. So these are the concepts that you need to study, and I'm actually winding in the topic today. I hope you guys understand today. So the reverse repo rate currently we have discussed. Current reverse repo rate is 3.35 percentage, and current repo rate is 5.5 percentage or 5.50 percentage. So that's all. I hope you guys understand the concept. We can just give a winding session. So today we have discussed what happens during monetary policies are implemented during deflation as well as inflation. During deflation, expansionary monetary policy is implemented. That is, all the rates are reduced during deflation. As a result, the commercial bank can take more loans from RBI. As a result, the lending capacity of commercial bank goes up, and the quantity of money supply in the circulation increases. On contrary, during inflation there is a lot of money in circulation. To introduce to or depump or to reduce the money in circulation, what RBI does is increase the rates. So as a result, when the rates are increased, loans taken by the commercial bank decreases, and the lending capacity of the commercial bank decreases, and the quantity of money in circulation also decreases. And after that, we have learned about tools used in monetary policy for controlling economic fluctuations, or that is inflation and deflation. So there are two methods. One is quantitative credit control measures or quantitative tools, and other is qualitative tools. Quantitative tools are most in numerical nature, and whereas qualitative tools are qualitative in nature. We can learn more in detail. So first we can learn about quantitative tools. There are mainly seven quantitative tools. One is bank rate or discount rate, another is reserve requirement um, rate, that is CRR, cash reserve ratio, and other is SLR, statutory liquidity ratio. Third is liquidity adjustment facility, that is LAF, that is repo rate and reverse repo rate. And then is fourth one is marginal standing facility rate, that is MSFR. And fifth is standing deposit facility rate, that was implemented during 2022, and that is the latest of the quantitative economic tools. And sixth is open market operations. Seventh is market stabilization scheme. And then we learn what is bank rate. Bank rate is the rate at which the RBI lends long-term loans to commercial bank in against an interest charge by RBI is known as bank rate. So here the RBI gives long-term loans to commercial bank. And next is during inflation, the bank rate is higher. The RBI charges a high bank rate, and loans taken by the commercial bank decreases, and lending capacity of the commercial bank decreases, and quantity of money supply also diminishes. During deflation, what happens is the bank rate decreases, and loans taken by the commercial bank increases, and the lending capacity of the commercial bank increases and quantity of money supply increases. So then what is reserve requirements? And out of every commercial bank, out of the total deposits, they need to keep a certain percentage as reserves, and this is known as reserve requirement. So the total deposits means there are two types of deposits. Mainly there is one is demand deposits and other is time deposits. Demand deposits are those deposits that can be withdrawn by the customers on their demand, and time deposits are those deposits that can be withdrawn only during maturity or during a specified time interval. So as a result, the deposits are totally known as net demand time liability. So, so among the total net demand time liability, the commercial bank need to keep a certain percentage as reserve. So if a certain percentage of the net demand time liability or the total deposits should be kept in cash to the RBI, and that rate is known as cash reserve ratio, and that ratio is CRR or cash reserve ratio fixed by RBI as on October is 3.75 percentage. As on statutory liquidity ratio is a certain percentage of the total net demand time liability that should be kept in gold, cash or securities with commercial bank itself, and this is known as SLR. So the current SLR is 18%. So 18 plus 3.75, total 21.75 percentage. Among the 21.75 percentage or approximately 22 percentage, bank cannot lend on that 22 percentage. That 22 percentage of the net demand time liability should be kept as reserve, and thus 78% is only allowed to lend by the commercial bank. So this is the concept of reserve requirements. And last but not the least, we have learned about liquidity adjustment facility. It is to adjust the liquidity of both RBI and commercial bank. So there are basically two kinds of liquidity adjustment facilities. One is repo rate and other is reverse repo rate. So current repo rate as on October is 5.50%, and the current reverse repo rate as on October is 3.35%. So what is repo rate? So repo rate is actually similar to bank rate itself. Only difference is that the repo rate is a rate at which RBI gives short-term loan, whereas in bank rate RBI gives long-term loans to commercial bank. Here in repo rate, RBI gives short-term loans to commercial bank, and they charge an interest to the short-term loan. That is known as repo rate. And whereas reverse repo rate is a reverse process where RBI lends money, sorry, RBI borrows money from commercial bank or short-term loan from commercial bank, and in addition to that RBI charges RBI gives an interest or pays an interest to commercial bank, and this is known as reverse repo rate. So one more point is that RBI has a monetary policy report. RBI has a monetary policy report or MPR. This is published 2 times a year. This monetary policy report is published 2 times a year or every 6 months. So the first 6 months RBI publishes a monetary policy report, and after the next 6 months also RBI publishes a monetary policy report. So by this I conclude today's sessions. I hope you guys understood till the topic which I've learned. So that's all. Thank you and have a nice day.